Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have back with me again this week David Jensen. Welcome, David.
Good morning, Jay.
We talked about some of the strange happenings in the precious metals markets, and today the markets are very much stronger. We're seeing gold up. Well, let's start with platinum is up some $30. Gold is up, $10 or so. Silver is up very strongly. Palladium is up $10 or so. All big percentage moves. What's going on here? Do you have any views?
Well, the speculation that we're seeing in some of the financial websites is that there was a bit of a tremor last week with the Chinese, what they call CFDs, or commodity financing deals, where bank loans are backed by copper and aluminum as collateral. And what has happened now is that the banks have found out that the warehouses that have been holding the metal for them have really been, let's call it, rehypothecating the metal, but basically promising it to numerous parties.
Huh.
And now there's a second port in China which has shut down shipment of base metals because there's a bit of a panic going on with these banks finding out that they're it's a situation which is very similar to the situation in the West here, where with the gold market and silver market, where we found out that some banks had been promising or rehypothecating the metals to numerous parties. Mm-hmm. Mm-hmm. And so the speculation is that as this CFD structure starts to unwind, as the banks basically realize that they can't trust the warehouses, is that they do a quick check. The first step is to see if they actually have the metal, but they're moving to unwind these positions. And typically what has happened is that to set up these base metal positions is that they would secure the metal through a third-party warehousing agent, and then sell a position forward as a hedge mm-hmm. to limit the financial exposure. So when you're unwinding these positions, the first step is to check for the metal, but the second step is to cover that forward that you have sold. So that if you sell forward, now you've got to buy to cover that position. Mm-hmm. And so what the discussion has been is that this lack of or loss of trust in the base metal sector by the banks would also start to impact them on the precious metal sector, where these similar types of deals have also occurred, but to some lesser extent. Mm-hmm. So check for your gold, number one, find out the damage that you've taken. Number two is to cover that forward position where you have sold into the market. So that would mean stepping into the market to buy. Mm-hmm. And then the third step is just get the physical. And this has been something we've always talked about, you and I and people in our discussion group, has been that you've got to secure the physical. Ignore the price, secure the physical. And I think this type of a dynamic may be entering the market now and may be driving.
Well, it certainly would make sense to me, but at the same time, my view is that these are relatively small moves. They're considerable moves for a couple of hours of time here, but nonetheless, David, I believe the magnitude of what we're talking about here in terms of the paper markets versus the physical markets would suggest that depending on how many times these physicals have been pledged out, that there could be a really gigantic move ahead of us here if this is just the start of it.
Yeah, it'll take several months for us to sort out what exactly is happening, but the speculation started last week with the exposure of this problem in China. It may be causing scares elsewhere, but it surprises me that it would impact the gold market because, we've been hearing about the Rabobank and the second bank escapes me right now, mm-hmm. from Holland last year, who closed out their gold positions, and the discussion had been that they had sold gold to numerous customers, and the customers were starting to claim the physical, and therefore they just shut down their total gold services department. But we've been hearing about this for several years now, and it's quite something that a Chinese base metals financial deal unwinding like this could impact the gold market. So maybe it's Chinese buying and Asian buying in the market, and they're just doubling up on the physical. I don't know. So we have to let the market sort this out and be patient to really find out what's going on. But it is interesting to me to see that it goes across all four precious metals this morning. Gold, silver, platinum, and palladium are all up strongly.
Well, you've been talking recently on this show, and you and I have been talking off mic as well about this, about the shortage in the platinum markets, the physical shortage because of the shutdown of the South African mines, and of course we've got growing geopolitical issues too that would suggest, in fact, I think I read somewhere last week that Russia is not only that is now in the market to buy platinum and palladium as opposed to being a net exporter of it. Is that your understanding?
Yes, Russia is 40% of the world's mine supply of palladium, and their state metals agency announced that they are stepping into the market to buy palladium. At the same time that we have the South African mines that have been shut down since January 23rd, and South Africa is 40% of palladium and 80% of platinum. So, you know, we have physical shortages hitting the market from this situation in South Africa, and then the Russian political situation impacting it as well. And you know, we could see a remarkable move in the platinum markets. Just to give a sense here, that platinum and palladium, you know, the gold mine supply is about 6 million ounces a year. The platinum palladium mining supply is about 6 million ounces a year. With gold, the mine supply is about 80 million ounces a year. So we have platinum and palladium mine supply is about 1/15 the supply of gold from mines. So you can imagine that a physical dollars moving physically into this space can have a lot bigger impact on platinum and palladium than it can on gold. I think also you and I discussed that historical moves of platinum has, you know, when there's been the strong moves in gold, platinum has either predated gold or moved with it. And I think that the predating of platinum moving first before gold is due to the fact that there is so little overhang in the market that we don't have the central banks sitting on large stockpiles of silver, platinum, or palladium, and therefore they are much more difficult to manipulate by you know, selling contracts, paper contracts, and then occasionally pushing physical into the market like they do with gold. To kill the interest. You know, it's not doable with platinum and palladium for the central banks.
Yeah, David. Yeah, I want to thank you for bringing this issue to my attention, because I've been able to do quite well when you alerted me to the fact that we're on the verge of a squeeze here potentially with platinum, and for my subscribers went out and bought North American palladium. As well as Stillwater Mining, and of course we had before that Wellgreen Platinum. So I think the listeners to this show might want to consider checking out some of those producers. The two producers there being North American Palladium and the bigger one, of course, Stillwater Mining. And so I think the economics with rising prices here for platinum and palladium look very, very good. Very, very positive, and Wellgreen, of course, is a little further along, further away. I mean, from any kind of production, but they do have what looks to me like a very prospective project in the Yukon. So
one final note there, Jay, on this, if I may interrupt, is that
sure.
In 1997 there was a similar squeeze in platinum and palladium, and it almost took down several banks in Europe who were paper short and unable to deliver the physical the metal to the market. And what happened at that time was that Russia stepped in with its stockpiles, which were estimated about being about 20 million ounces of palladium, and they helped to cover the shorts of those banks. This time around, it appears that we're having a physical squeeze starting, and Russia is entering the market and buying the metal, not helping to cover the short positions of the banks. So we saw Putin saying that they wouldn't respond to the sanctions from the U.S. and the West, and that they had other methods. That wasn't their approach to things, and maybe we're seeing their approach to things now.
Well, go ahead.
Yeah, they could take down the physical market in London if there's a run on physical metal now.
Yeah, well, that's very interesting. Clearly, those three metals that you mentioned, the gold, or silver, platinum, and palladium, are not in supply, and the banks don't have the ability to to play with them and manipulate the prices. And so, yeah, I mean, this geopolitical thing is very interesting to me. What's going on in the Ukraine and elsewhere, and but let's talk a little bit about the markets. Silver remains. You said, I think you said this morning that it's still selling in the. It remains at a premium in the Shanghai. That is the spot price is at a
Yes.
strong premium still.
Yes, it's gone up. It's 6.6% today, and this may indeed be why they've shut down the London silver fixing. Is that for the last year now we've seen that Shanghai has fairly steadily been trading at a premium to London, and it appears to me that what's going on here is that the physical metal is setting the price, and London isn't really a physical market per se. I mean, the Reserve Bank of India estimated that the gold leverage in the London market was about 92 to 1, so we can call it, let's say, 100 to 1 for round numbers. So 100 paper positions for every real physical position. And silver would be the first one to go because of the lack of control of the physical metal by the central banks. I would expect that the gold market would go thereafter at some point in time. But August 14th, they're shutting down the silver fixing in London after 117 years, and certainly something is going on there. And I believe it is that the physical markets, as you and I have discussed in the past, will become the real markets, and we will basically shunt to the side the paper markets in New York and London because they don't actually trade the metal to set the price.
So people will simply not want to go. People that are serious about buying the metal will simply not be going to those markets where they can't deliver the metal. I guess it's simple as that.
Yeah, there's no trade here per se. It's just secure the asset.
Yeah.
And this is the critical thing as you hear about price resistance and the technical analysts looking at the charts. And I mean, I really look at all of these things as virtual reality, and it's living within a matrix of thought, which is really a deception as a whole. And the issue here is that you've got hundreds of claims per ounce out there. Just secure the metal. And that's the beginning of the trade, and that's the end of the trade.
Well, David, as long as people remain confident in the paper monetary system, then they don't have those demands. I mean, there's no reason. It's just basically a hedge instrument, a trading instrument, and people don't. It's really like a casino. These markets these paper markets have become like casinos, haven't they? Virtual markets, essentially, nothing to do with the physical. I would think that the same thing would be going on then in platinum and palladium, where your lease rates rising sharply there recently. Is that still? I would think even more so today, perhaps.
Yeah, I haven't checked the lease rates this morning, and it's Kitco, which has been the source for the lease rates outside of having to go to the banks, which I've started to do to get some numbers. But they've really suspended regular posting of their lease rates and regular and reliable posting. But the lease rates over the last 2 weeks have basically doubled from where they were, and I am following the lease rates closely because that signals physical availability of the material. And I find it's, for myself, in these small markets like platinum and palladium, a much more reliable benchmark than trying to follow the actual price. There's infinite availability of the material to market in the paper market. Leasing gives you an idea of the availability of the physical metal and what the terms are for a temporary loan of the material. So it's a reference point, and Shanghai and the platinum and palladium have risen very, very sharply over the last few weeks in the lease market. So that gives us an indication.
Changing subjects just a bit here. Kyle Bass says that China has been its economy has been contracting since the fourth quarter of last year and into the first quarter of this year, and that its property bubble is bursting. You would think that might be bearish for gold and other precious metals, no?
I don't, because a lot of wealth has been residing in real estate. But I mean, backing up. So if you don't trust the real estate market anymore, where else are you going to go? But backing up one step, what has been causing the real estate market to take off has been the creation of money in China. And the reference point that we have is over the last 5 years, there's been $15 trillion of loans created in the private banking sector in China. which is in round numbers roughly twice the GDP of the economy. So that would be similar to, let's say, $35 trillion of loans in the United States over the last 5 years. We're hearing stories about the bubble is collapsing in various Chinese cities, and one story that I saw of note was that they have deals now: buy one floor, get one floor free in a high-rise in Shanghai. So that's how crazy things get when you overproduce money and credit, and this is what we've seen in the West over the last 20 years. And it's certainly what we're seeing now in China is just this incredible liquidity which has been created. You get bubbles, and then you get bubble collapses, and then there's a rush for things which are real and tangible that you can't create from nothing, and that is typically the precious metals, which is the bane of the banking sector.
You know, at the same time, while this is going on, I think if it were going on in the United States when we had a property bubble, that there would be a move for paper money. The dollar was stronger relative to other currencies, stronger relative to goods and services. We actually did have a very brief deflation in the United States following the Lehman Brothers contraction. But I notice in China here that the country is approving International Board for Foreign Physical Gold Buying in Shanghai. So, I mean, the move in China has been gold friendly for many years now. There is it is in the ethos of the Chinese people, the sense of realness, gold. They understand it. Americans have been programmed not to understand it. The people in the West have been programmed to trust the PhD standard, as James Grant says, rather than the gold standard. But at the same time, I hear what you're saying here now. When there's a rush for safety and liquidity, there's nothing, as John Exter pointed out, nothing more liquid, more safe at the bottom of that inverted pyramid than gold. And the Chinese seem to understand this, and I mean, this just struck me as you were saying that China has now approved, you know, this International Board for Foreign Physical Gold Buying in Shanghai. At the same time, the Russians and the Chinese are clearly moving towards some sort of a trade agreement, setting up their institutions so they can step outside of the U.S. dollar system, and so I could see where, and looking at the gold markets, the amount of gold that's available in the world is so minuscule compared to, you said this, $15 trillion worth of money that's been created out of nothing from China, and every country is doing it. So as denominated in paper money, I mean, it's hard to say where the price of gold could go, or any of these other precious metals.
There is no target. It's just basically it's a collapse of a credit bubble and basically a bubble financial system. But you know, John Exter's writings, I've been reading them again recently in detail, and it is amazing the understanding that he had. I mean, he was born in 1910 and he passed away in 2006. But you know, he had served on the Board of Governors of the Federal Reserve, and he was very, very clear in his warnings and about what happens with these types of non-gold-backed monetary systems when you just have one where they call it a floating currency and a floating price of gold, and he said really what you had was a sinking currency, where the value of the currency was sinking versus gold continually. And the inverted pyramid, where he had derivatives on top and then going through various financial instruments, residential real estate and commodities, and moving down through treasuries, cash, and ultimately down into gold at the very fulcrum of the pyramid as it's inverted. That pyramid, he said, would collapse, and it would collapse down into the only valuable asset holding, true wealth, and that was gold in the end. And it's just, I really encourage people to look up John Exter. EXTER is his last name, and there's a profile on Wikipedia, and then go do your own research. But it is amazing the understanding that he had, and he said long ago that this financial system, this unbacked, irredeemable paper money system, he coined the term, instead of IOU, the dollar used to be an IOU where you turn in the dollar and receive gold for it. And he calls our current unbacked money system an IOU nothing.
Right. It's exactly what it is.
Yeah, and it's Larry Parks has a wonderful description of it. He says that we used to turn in gold coins at the banks, and then you'd receive a paper wrapper back, for it. Let's say you bring a roll of coins in, and they give you the wrapper signed so that you could get your gold back as a receipt. And he says basically they demonetized gold, and now everybody's running around with these coin wrappers thinking that they're money. And it is a kind of a stark analogy to give, but it really is one that I think is apt.
Yeah, John Exter was, of course, known for his deflation theories, and I've had discussions with James Turk and others about Exter, and Turk makes the point, and I think it probably is really in agreement with Exter, but the only thing that will really be deflated, or the only thing that will gain purchasing power, will be gold, essentially, and I think Exter definitely believed that as well.
Yeah, I mean, I look at it in terms of, first you have a deflation as there's a crippling of the economy with the debt structure that exists when you can create limitless debt, and that you will initially have deflating asset values as the bubbles collapse. But then in the end, when your currency collapses, then you have price explosion for strategic assets like food growing facilities, oil, port facilities, and Peter Warburton touched on this in his 2000 paper as well, regarding the creation of money and the creation of money being inflation, but not as we've historically been led to believe. So I think the Chinese, going back to your point about opening up the Shanghai Gold Exchange for foreigners, what they are doing is providing gold liquidity to foreigners who hold yuan. And we can see clearly here what they are doing is they are basically detonating the gold market with this move, because you will have people that will move into gold, and we know that the fraction of gold out there versus the fraction of other financial instruments is on the order of thousands. It's a thousandth of the amount of paper that's out there, or more. And just as a point of reference, we can look at the bond market. The global bond market is $100 trillion. All the gold ever mined is of the order of about $7 trillion. But if you want to look at the physical metal which is available in the market, it is well less than $500 billion. And that gives you a sense of the leverage that exists out there. And China, by opening up this physical gold market in Shanghai, and they have to do it to have the yuan accepted, because you don't want the yuan. What do you want to hold Chinese yuan for? What are you going to use it for?
Right.
So they have to do it to bring people into yuan, to want to hold the yuan. And what they're doing is basically replicating what the United States did prior to 1972. Is that they said, if you hold our currency, we will give you access to gold. And United States, Paul Volcker and all these guys were lobbying. Kissinger, David Rockefeller, and all those guys were lobbying to get America off the gold standard. And John Exter, I'm sure he was close to tears when he saw that, because he knew that would be the destruction of the dollar and the destruction of the United States that would come with it in terms of its dominant position.
Yeah, I mean, those are the guys that you could say are the foxes that are guarding the chicken coop, because now with gold detached, it allowed them to reallocate wealth in their direction and away from the people that create wealth. I like to say the miners, the manufacturers, the farmers, and the inventors. But David, I think that's a really interesting choice of words that you said. The Chinese are detonating the gold market, and I hadn't thought of it in these terms, but they're not willing to let people come with their dollars to Shanghai and buy gold. I guess what you're saying is it's really for the yuan trade, huh?
Yes, it's to have the yuan accepted globally, and so if they're going to this, and it's still unclear in terms of specifically how that gas deal was settled with Gazprom between China and Russia. But if the settlement mechanism is there in yuan, I mean, Russia has need for some yuan in terms of its trade with China. But the other portion of it, you'd like to secure something that has innate value. And as America did prior to 1972, it gives the ability of the yuan holder to say, I trust this because it's as good as gold. And that's what people used to say about the U.S. dollar, right? It was as good as a dollar, which is as good as gold, because I could just go and exchange them. But then, unfortunately, there was the default in 1932 on gold holdings for the American people, and then in '72 there was the default in terms of the gold availability for the dollar for international holders. Yeah.
Well, it really seems to me that the Chinese are, and the Russians, and maybe the BRIC countries as a whole, are in the process of setting up institutions to compete with what I think is really unfairly has really been an unfair system that allows the creators of IOU nothings to dominate the world scene militarily and exploit and take over a lot of different countries. I know that the neocons in this country would probably think that anybody who talks that way should be tarred and feathered. But I think it's really interesting what you're saying, because you know, you and I talked about Volcker is calling. I mean, this was in the news last week, I think. Volcker is calling for a new Bretton Woods, and it strikes me as if the Chinese are already providing a new Bretton Woods, a return to Bretton Woods, if you will, or something similar to that. And yet, that's certainly not what Volcker has in mind. I'm sure, if anything, perhaps along with James Rickards and that sort of school of thought, going to an SDR type of situation where the United States still has the majority of SDRs in the IMF. What do you think? I mean, are we going to come to some sort of a major confrontation here between the West and the East with respect to this monetary system? Is this basically a tectonic plate rubbing against each other here?
Well, you know, talking about it in terms of competition and conflict, I certainly can see how things can be perceived that way. Mm-hmm. But if we look at Extra's writings, he's just talking about inevitability. Mm-hmm. And, you know, the return to gold is an inevitable terminus point. Mm-hmm. And so the Chinese, you know, are they competing, or are they making sure that they have a functional currency and that others have functional currencies when the dollar collapses, as John Extra was very clear that it would? Mm-hmm. And so what we may have here is that people out of country are reading and thinking about the words of Extra and many others, or several others parallel to him. I don't know how many match his expertise, but really they are just digesting the information, understanding, and then moving to stabilize their currencies when this inevitable collapse occurs. Because America has basically been seized by the financial sector and has been run off the cliff. Tens of trillions of dollars have been made over the last 20 years as the gold market has been shut down and the bond market has been basically almost anesthetized. Maybe you know, that's the right term. But you know, what I would expect to see now is selling of bonds. And initially a spike in the dollar as people settle their bond trades in dollars and then go into gold. But back to the original point there is that these markets, these countries have really been protecting their people by ensuring the functionality of their currency, while this insanity has gripped, let's say, America and Europe for that matter as well.
Mm-hmm. Well, no question about it. I mean, when you talk about the forces and the special interests that convinced Nixon to take us off the gold standard, these are people that, as I just pointed out a few moments ago, that allowed them the dollar system, the ability to create money out of nothing, allows the people that have control of the monetary system, that is the Federal Reserve and the government essentially, to reallocate wealth away from the producers of things towards the consumers and towards the rich and, you know, the 1%, if you will, the folks that are getting extremely wealthy. And I'm sure you would agree with me, David, nothing against wealth if it's earned through the marketplace, through a fair and even playing field marketplace, as opposed to the kind of crony capitalism or crony fascism that we have now. But any other thoughts before we conclude our discussion today about the markets and where people should be looking? I find it very interesting, and I'm going to comment after we're finished on the last segment of today's show about some of the markets that Michael Oliver talked about being very closely linked, and Michael's view is sort of along the lines of what you said, and his momentum work is suggesting a shift to a higher gold price, to a higher dollar initially, and weaker equity prices. And I don't know where he stands on the bond markets, and I want to talk to him about that. But any closing thoughts?
Well, the short term and intermediate term is always difficult, to peg. Especially when you're dealing in markets which are influenced by the printing of money, and who knows where that goes. But I think, Jay, where we're headed is we're heading back to what is the only sustainable thing, which is that wealth is created by work and savings.
Yeah.
And that you can't you can't print wealth, which is what we've been taught. That when the economy slows down, that we just juice things and juice here and juice there, and everything will be okay. And what we've seen here is that the banks have been bailed out, and after the Lehman Brothers crisis, and then they were the wealthy who 5% of the population hold 85% of the equities. They've been benefited by the QE and the leverage that came out of QE for the banking system to juice the markets, and it's all unsustainable. It's all temporary, and I really encourage people not to try to play short-term trends, but to look at John Exter's work, look at that inverted pyramid, and understand where the end station is, and that there is only really one move here, and it's not really a tradable event.
All right, well, I want to thank you very much, David, for being with us once again. We'll look to catch up with you next week, hopefully, and talk about some more of the developments in the markets. I just get the sense that we could be on to some major shifts here, and certainly some of the people we've been talking to on this show have been predicting a turn in the gold markets in the second half of this year. Looks like
the Chinese already are very positive towards gold, and there may have been some which are being scared by this the CFD coming unwound in China, the commodity financing deals with copper coming unwound, and they may be doubling down on their demand now. So we will have to see where it goes, Jay.
Yeah, it's very interesting. Well, we'll look to catch up with you next week again, David. Thank you very much for spending time with us.
Thanks for your time, Jay.
Folks, don't go away. I'll be right back with some closing thoughts this week on the markets and a couple of my favorite stock picks. So don't go away. I'll be right back.